Welcome to Crypto West Coast, where we discuss everything crypto from a Canadian perspective. My name's Damien, and today I'm going to take a look at how Revenue Canada views cryptocurrencies from a taxation point of view. Don't shoot the messenger. I'm only here to share with you my understanding of how Revenue Canada treats cryptocurrencies from a taxation point of view. Hey, the only things guaranteed in life are death and taxes. So let's get started. In case you don't know, I'm in no position to give tax advice. There are several websites that a simple Google search will give you tax information regarding digital assets, and I use the CRA website along with a Coinly blog, adjusted cost base website, and Canada Pay website, which all these really simplify what the CRA website is stating. Links to all these sites are listed down below, along with other information, including my Canadian exchange spreadsheet that goes through some of the Canadian exchanges I use, referral links if you so wish to use them, as well as some fee structures, advantages and disadvantages, and which ones I use the most. I'm not going to read off of all these websites, but some of the highlights are as follows. The CRA generally treats cryptocurrency like a commodity for the purposes of the Income Tax Act. Any income from transactions involving cryptocurrency is generally treated as business income or as capital gains, depending on the circumstances. I suggest you visit the CRA website to help determine if you are acting as a business or simply as capital gains. But basically, if you are generating a lot of your income through cryptocurrencies, it would be considered a business, and 100% of crypto-related business income is taxable. But if you're like most of us and you're treating cryptocurrency as a hobby, then any gains you make would be considered capital gains, and 50% of the gains is taxable and is taxed based on your tax bracket. So to clarify, and to keep things simple, let's say you sold some cryptocurrency and made a $100 profit. 50% of that, or $50, is considered a gain, and you would add that $50 to your total yearly income as a $50 gain. Continuing, to figure out the value of a cryptocurrency transaction, where a direct value cannot be determined, you must use a reasonable method, keeping records to show how you figured out the value. But generally speaking, whenever you make a trade or a purchase on a cryptocurrency exchange, it is not hard to find the records of these trades or purchases, and you can record it or download it for your records. If you hold more than one type of cryptocurrency in a digital wallet, each type of cryptocurrency is considered to be a separate digital asset and must be valued separately. For example, a Bitcoin is valued separately from a Litecoin. Of course, this is just a general overview of the tax implications regarding cryptocurrencies. Things like borrowing, lending, initial coin offerings, mining, staking, and farming are all components that need to be considered when calculating cryptocurrency taxes. Moving forward, let's talk about what is and what is not a taxable event regarding cryptocurrencies. First of all, what is not a taxable event? Well, there are no taxes for just buying and holding cryptocurrencies. And there is no taxes when moving cryptocurrencies from one wallet or address to another. So simply buying and holding cryptocurrencies is not a taxable event. So what is a taxable event? When you convert one type of cryptocurrency to fiat currency, such as Canadian dollars, taxable. When you dispose of, in the form of a trade, one type of cryptocurrency to acquire another type of cryptocurrency, for example, if you trade Ethereum for Bitcoin, a taxable event. When you dispose of or sell cryptocurrency, or you give a gift of cryptocurrency, that is a taxable event. When you use one type of cryptocurrency to purchase a good or service, taxable event. Trading or selling to a stable coin is a trade, thus a taxable event. Mining cryptocurrency is a gain only when disposing of the cryptocurrency. And it says that the cost basis would be zero in this case, as no money was spent acquiring it. Thus, the entire sales proceeds is considered a gain, and 50% of that gain is now taxable income. And finally, hard forks and staking would be considered the same as the mining example above. So now that we've discussed what is and is not a taxable event, it is important to keep accurate records of all of the purchases, trades, and sales that you make. The CRA is clear that you need to keep accurate records of all your crypto dealings. Whether you use crypto tax software, for example like Coinly, or you do it yourself on paper or spreadsheets, you are expected to keep records of your transactions. Exchanges will have a record of all your transactions, but most will not keep a proper recording for tax purposes. If using multiple exchanges, it would not be possible for the exchanges to keep accurate tax records. If you will be using a crypto tax software, you need to send files generated by the exchanges and wallets you use to the provider of the tax software. If you are doing your own recordings, you will need to provide the following: the transaction date, the action, the number of units involved, the price of the units, the fees, the average cost base, and any gains and losses that you make. I myself have not used software to record my purchases, trades, and sales. I began with a spreadsheet, something like this, and over time I've made revisions, and now I'm at the point where I'm competent and confident that what I am recording is correct. I've also used a free website called Adjusted Cost Base, where I can enter cryptocurrency purchases, such as Bitcoin, and see that the calculations that are made on this website match the calculations that I'm making on my own spreadsheet. But there are many companies who provide crypto tracking services such as Coinly, CoinPanda, and many more if you just do a Google search. All of these providers offer a free service to begin with, especially if you have a small number of transactions. As your transactions increase, a fee will be associated based on how many transactions you make in a year. So as I wrap up this video, my intention was to identify when a taxable event takes place regarding cryptocurrency, and to remind you that you should always be keeping track of all of your cryptocurrency transactions. Again, don't shoot the messenger, but I'm sure as cryptocurrency and digital assets become more mainstream, our Canadian government going to do everything they can to make sure they get a fair share of our gains. So it's probably a good idea to track those transactions, report our gains, and avoid an audit. Thanks again for watching. If you got any value from this, please give me a thumbs up. It costs you nothing, and I hope to see you in the next one.